Home equity loans and home equity lines of credit. HELOCs are loans that are secured by a borrower's home. A borrower can take out an equity loan or credit line if they have equity in their home. Equity is the difference between what is owed on the mortgage loan and the home's current market value. In other words, if a borrower has paid down their mortgage loan to the point that the value of the home exceeds the outstanding loan balance, the borrower can borrow a percentage of that difference or equity, generally up to 85% of a borrower's equity. Because both home equity loans and HELOCs use your home as collateral, they usually have much better interest terms than personal loans, credit cards, and other unsecured debt. This makes both options extremely attractive. However, consumers should be cautious of utilizing either. Racking up credit card debt can cost you thousands in interest if you can't pay it off, but becoming unable to pay off your HELOC or home equity loan can result in losing your home. Home equity loans give the borrower a lump sum up front, and in return, they must make fixed payments over the life of the loan. Home equity loans also have fixed interest rates. Conversely, HELOCs allow a borrower to tap into their equity as needed up to a certain preset credit limit. HELOCs have a variable interest rate, and the payments are not usually fixed. Both home equity loans and HELOCs allow consumers to gain access to funds that they can use for various purposes, including consolidating debt and making home improvements. However, there are distinct differences between home equity loans and HELOCs. A home equity loan is a fixed-term loan granted by a lender to a borrower based on the equity in their home. Home equity loans are often referred to as second mortgages. Borrowers apply for a set amount that they need, and if approved, receive that amount in a lump sum up front. The home equity loan has a fixed interest rate and a schedule of fixed payments for the term of the loan. A home equity loan is also called a home equity installment loan or an equity loan. The equity in your home serves as collateral, which is why it's called a second mortgage and works similarly to a conventional fixed-rate mortgage. However, there needs to be enough equity in the home, meaning that the first mortgage needs to be paid down by enough to qualify the borrower for a home equity loan. The loan amount is based on several factors, including the combined loan-to-value (CLTV) ratio. Typically, the loan amount can be 80% to 90% of the property's appraised value. Other factors that go into the lender's credit decision include whether the borrower has a good credit history, meaning that they haven't been past due on their payments for other credit products, including the first mortgage loan. A home equity loan's interest rate is fixed, meaning that the rate doesn't change over the years. Also, the payments are fixed, equal amounts over the life of the loan. A portion of each payment goes to interest in the principal amount of the loan. Typically, the term of an equity loan term can be anywhere from 5 to 30 years, but the length of the term must be approved by the lender. Whatever the period, borrowers will have stable, predictable monthly payments to make for the life of the equity loan. A HELOC is a revolving credit line. It allows the borrower to take out money against the credit line up to a preset limit, make payments, and then take out money again. With a home equity loan, the borrower receives the loan proceeds all at once, while a HELOC allows a borrower to tap into the line as needed. The line of credit remains open until its term ends. Because the amount borrowed can change, the borrower's minimum payments can also change, depending on the credit line's usage. Like an equity loan, HELOCs are secured by the equity in your home. Although a HELOC shares similar characteristics with a credit card because both are revolving credit lines, a HELOC is secured by an asset, your house, while credit cards are unsecured. In other words, if you stop making your payments on the HELOC, sending you into default, you could lose your home. A HELOC has a variable interest rate, meaning the rate can increase or decrease over the years. As a result, the minimum payment can increase as rates rise. However, some lenders offer a fixed rate of interest for home equity lines of credit. Also, the rate offered by the lender, just as with a home equity loan, depends on your creditworthiness and how much you're borrowing. HELOC terms have two parts. The first is a draw period, while the second is a repayment period. The draw period, during which you can withdraw funds, might last 10 years, and the repayment period might last another 20 years, making the HELOC a 30-year loan. When the draw period ends, you cannot borrow any more money. During the HELOC draw period, you still have to make payments, which are typically interest only. As a result, the payments during the draw period tend to be small. However, the payments become substantially higher over the course of the repayment period because the principal amount borrowed is now included in the payment schedule along with the interest. HELOCs can be useful as a home improvement loan because they allow you the flexibility to borrow as much or as little as you need. If it turns out that you need more money, you can get it from your line of credit assuming there's still availability without having to reapply for another mortgage loan. You should ask yourself one question: what's the purpose of the loan? A home equity loan is a good choice if you know exactly how much you need to borrow and how you want to spend the money. When approved, you're guaranteed a certain amount, which you receive in full when the loan is advanced. As a result, home equity loans can help with big expenses such as paying for a children's college fund, remodeling, or debt consolidation. It's important to note that obtaining a HELOC may be tougher in 2021. In 2020, two major banks, Wells Fargo and JP Morgan Chase, put a freeze on new HELOCs as a consequence of the coronavirus pandemic. Other banks could put a lock on credit in the future. And we are almost wrapping up. These are the common differences between these two. Hope you liked this video. Please comment, share, and subscribe to this channel for more videos.